I'm going to see if I have memorized this intro. Here we go. Welcome to the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And in this show, what do we do? We talk about the goal, that's it. The goal of the show is to help people invest wisely in both people and properties so that together we can not only build wealth, but we can also improve housing. I'm James, and this is my wife, Jessie.
I'm here. I'm itchy, but I'm here.
You're itchy.
It was so nice. I had to garden a little bit, but I know every time just pull a few weeds and I'm sneezing and itchy.
Yes. That's one of the joys of living in Oregon.
Yeah. Gotta wait for my allergy meds to kick in.
Oh, that's good. That's all right.
It's all right. It was fun.
It's
worth it.
You know it. That's like me, if we may enter into a little bit of a TMI for a moment here. Boy. I can only have so much cheese. and
before your body disagrees.
Yeah. And I don't care.
You know it.
I just own it and go, totally worth it. Like, for example, on Easter, we had personalized pizzas. And I just extra cheese on mine. And yeah. I did like your comment the other day. You're like, yeah, you may not care, but the rest of us does.
Yeah, definitely TMI.
Yeah. But you know what? Again, as long as you're being intentional, I'm okay with sometimes making poor choices.
Well, I take allergy meds. So I can deal with the itchy. So, maybe there's some
could do that,
tummy
but
meds.
Won't. Oh my gosh. Yeah. Awesome.
How did we get there?
Dude, this is just real talk with
Speaking of investing in your health.
Yeah. No, what I actually want to talk about today is 5 levels of investing. And this comes directly from Robert Kiyosaki's book. It's one of my favorite. It's Cashflow Quadrant. Mm-hmm. And in it, if you may draw a picture in your mind, there's 4 quadrants. In the upper left-hand quadrant, which is now your right, in the upper left-hand quadrant, you have E, which stands for employees, people who have a job. Lower left-hand quadrant, I'm doing this opposite so that it all makes sense on the camera. It's S, which stands for self-employed, people who, he likes to say, own a job, but essentially it's a small business, you're working for yourself. And then upper left-hand quadrant, right-hand quadrant, you have B, which stands for business owner. And the definition or the difference between a business owner and someone who's self-employed is that with a business, it can run on its own. It doesn't require you to be present to work. As a matter of fact, one of his tests is if you left for 3 months, is it actually running just as well, if not better, than when you were originally there. And then the lower right-hand quadrant are I, investors. And this is where it's money working for money, essentially.
Cool.
And so he dives into that I quadrant a whole bunch more and essentially calls out 5 different levels of investing, even though I think he starts with level 0 and goes to 4. And so I just want to talk about them because I think it's a really interesting concept. I think it's just good to kind of understand where you are and maybe you want to be there, maybe you don't want to be there.
Sure.
And just kind of, understand it. I think that's good. So the first one, let's see if you can guess what some of these are. I know did you ever read the book or have I just told you about it?
No, I've read the book.
Okay.
I thought it was super interesting.
Okay. All right. You read Rich Dad Poor Dad.
I read Rich Dad Poor Dad and I read...
I don't have it here because I gave it away for someone to read.
Oh. Yeah, I read Rich Dad Poor Dad. I've read some stuff that his wife has written.
Oh, yeah. Mm-hmm. Don't have this on the shelf because these are all my awesome books. But that's okay.
Yeah, no, I read Cashflow Quadrant.
All right. Well, I'm going to test how good your memory is from reading this, 15 years ago? Mm-hmm. Yeah, let's go. All right. So the first one is called... Okay. Kiyosaki, he can sometimes be a little bit brutal in his language. I just want to put that caveat out there. I don't necessarily I like his concepts. I don't necessarily agree with the way that he presents them. He can be a little mean about it. But anyways, the first one is called the 0 financial intelligence level.
I mean...
All right, so
if you're not doing anything,
what does that mean?
That means you're not really doing anything with your money.
Yeah, 100%.
You just...
Yeah, he says there's no significant investment.
Yeah.
And it's virtually non-existent. And he says usually people in that stage, they're focused on survival.
All right. That kind of makes sense because it's either A, you don't know what to do, or B, you don't have anything to do investing with.
Right.
So it's like, I don't even have enough to pay my bills. Like, why would I invest in something?
And my guess is anyone listening to this is not in this category. It really is like legitimately paycheck to paycheck type of stuff. No savings going on. You're maybe not food stamps level, but like maybe that kind of thing. All right. So level number 2 is the savers are losers level.
Savers are losers.
Yeah. So what do you think?
I'm guessing you just like put it in a hole or a bank account, maybe. dig a hole, put it in a jar, dig a hole.
Yeah, nice bad. Not put it in a hole, but they just save it. Oftentimes, these are people who they save because they are risk avoidant. Mm-hmm. So when you think about the Jesus' parable about the talents,
that's exactly what I was thinking about.
The
guy who buries it.
Yeah, that's
like, well, I don't want to lose it.
Yeah.
I'm not confident I could make it grow, so.
Yeah, and I'm not going to bridge any spiritual connections to people who save. But yeah, it's that visual that you should have. And essentially one of the big problems that you have with that is inflation. Mm-hmm. Because typically savings accounts, whatever they are just not going to give you, they're going to be less than inflation. As a general rule. Mm-hmm. And so if you're saving your money, which is like in a money market account, potentially even just put it in the bond market, though recently that's less true. Mm-hmm. It's, did I say money market accounts already?
Yeah.
Savings account, which I believe you should have some money.
Yeah, that's what I was going to say is you should save something, right? Because there's something to be said about putting a certain amount of money in a savings account that's liquid, in the sense of if I need this because I had an emergency or had to go to the hospital or whatever, I have the buffer in my life that I can pull that out. If you invest it may become less liquid or less available. Mm-hmm, mm-hmm. It might make more, but you can't get it right away necessarily. So,
and that's us. We've got, I'm trying to think what the number is. I'm trying to do the quick math. I guess we have 5 months of expenses saved.
Yeah.
It might only be 4, but that's just
which it's 3 to 6. Account. I feel like is a good buffer.
Yeah, and then I have probably the same absolute number in the business account saved up. And it's just there, just savings.
Right.
And it's because it's good to have something that's liquid. Yeah. So it's not to say, but that's their primary.
Right. If that were where you were putting all of your cash.
Yeah, that could be a problem.
Wouldn't necessarily be growing.
And so he calls them losers, not because he's not attacking their character.
Pretty brutal.
He's not attacking the character. He's saying you're losing to inflation. You're not. Yes, your absolute number might be going up, but your relative, your real number is losing.
Yeah,
it comes off as harsh, but he's got some meaning behind it. All right, level number 3, the I'm too busy level. What do you think that one is? This one's a little trickier. And this is honestly where the majority of people fall.
Yeah, I'm guessing
you're careful with your words.
I'm guessing on some level you're giving it to someone else to either invest for you or...
Yeah.
Which I would think is the stock market.
Exactly. Yeah. They recognize the importance of investing, but they got a lot of other stuff going on.
Yeah.
Maybe baseball practice or whatever.
Or work.
Serving at the church.
They might be in that E quadrant.
Yeah, the old E quadrant. Yeah, totally. And so they hand off their investment decisions to financial advisors or to mutual funds.
Yeah.
Yeah, pretty classic. And they do experience some moderate growth. So I copied off some quotes here that he had about level 3, which I just thought were interesting. So for example, he says the problem with a level 3 investor, that's the I'm too busy, is that they learn nothing if they lose their money because they weren't doing the investments. They've handed it off to someone else. So they have no experience except for maybe a bad one. And all they can do is blame their advisor or the market or the government or whatever. And it's just hard to learn from your mistakes if you are not involved in your investing at some level. I also thought was interesting. What I also thought was interesting is he talks about some problems with 401ks, which my mom's going to love this part since that was what she spent her entire career helping people set up. But I thought this was super interesting. And again, I've probably read the book a couple times, and I was like, oh yeah, that's right. He says long-term capital gains are taxed at a lower rate of around 15% federal. And he goes, but 401k gains, do you know what they're taxed at?
Nope.
Your ordinary income tax rate around 35%.
Yikes.
So he says it's the highest of all types of income. So if you want to take money out of your 401k early, you have to pay an additional 10% penalty tax.
So no matter what, you pay 35% even after you hit retirement and you do the full investment.
I didn't think that was...
I didn't think that was the case. I mean, you have to wait a lot longer to access it, but once you wait, it seemed like you didn't have to pay as much. But
so what he talked about is he says that financial planners will often say, when you retire, you'll be taxed at a lower rate. And that's because they assume that your income will go down in retirement to a lower tax bracket.
Ew.
Which is like, so your financial advisor is telling you you're going to be poorer today or poorer when you retire than you are today. And I remember my mom explicitly talking about that kind of stuff because she's like, well, you have certain expenses now that you may not have in the future. Like, say, for example, raising kids, or there's certain things that you pay for because you have a job, like maybe like new clothes. Driving. Yeah, like those will generally go down. And
Interesting.
But for him, he's like, why in the world would you plan for lower income when you retire?
Right, with inflation.
Like, the goal is to like make more. Yeah, so
you would think.
That was just kind of his... Yeah, I thought that was, now making me question whether or not you get taxed at the end. I don't really care because I don't have a 401k, so it's not important to me. I feel like you would be, because I remember when I left HP, it rolled over to an IRA, and it wasn't a Roth IRA, it was just a regular IRA. So I would imagine that means that you do pay taxes afterwards. I don't know. So last thing here that he talks about specifically to like the 401k things, or just the I'm too busy level in general, is he says the reality is that real investors do not park their money. They move their money. It's a strategy known as the velocity of money. A true investor's money is always moving, acquiring new assets, and then moving on to acquire even more assets. Only amateurs park their money. And
is there like a hybrid of sorts where you could invest in those sorts of investments but be more involved, so you're moving your money and watching the stocks? And
I think so. And that's one of the things, and we'll kind of get into the next level here, that that passively investing in real estate kind of gets you there, right? You don't it's going to be in between this next level, which is like the I'm a professional DIY level, and this I'm too busy level. Because you have to be involved. You have to understand the investments. You are going to learn from failures or successes. So there's some additional education that's required, but you don't have to do everything yourself. You can lean on other people. So I think that's why one of the reasons why I like people investing in other deals. I think it's that good hybrid. Because if you are too busy, that's awesome, but you can also get some bigger returns than just handing it off and doing nothing. And I think what he's really trying to say is for the I'm too busy, it is like the 401k. I'm not even going to worry about it. I'm just handing it off to somebody else.
If someone wanted to invest in your properties like that, would you be okay with that?
What do you mean?
Well, I mean, you said there's a level of learning, but I kind of feel like if they just trust you and they're like, yeah, I don't care. I don't want to learn. I know that you're going to get me a return. Here's the money. Invest it. You're good to go.
Yeah. I mean, I'd still probably want to share information with them anyways.
What if they don't care?
I don't know.
Because they're too busy.
Yeah, genuinely people who are too busy to care, like they're not doing this. They're not taking the time to learn about other investments.
Interesting.
Because they're too busy.
Huh. I don't know. I kind of feel like you could have someone invest in one of your properties and not really have to know or understand how the deal works.
The thing to talk about for like these last 3 levels is that there's pluses and minuses to each of them.
Sure.
Like if you have other stuff and you love your job, like go in all on that. Like be too busy to do the investment side. Your job is where you're investing, and that's totally okay. There's trade-offs. Chances are you're not going to make as big of a return as if you focused all your energy and effort into the investment, but maybe that doesn't matter because you're going to get the huge return in your job, and that's okay. So I could totally see that. Does that make sense?
Kind of.
All right. Level 4. It's called...
I feel like you could be a lot more passive than you're making it sound, investing in syndications or real estate deals.
Yeah, you could. I don't necessarily recommend it, I guess. Like you should know what you're putting your money into, because you should know. Because there is genuinely risk and there's unknowns, and it's not like you're going into the total market index and like and you're going to get the average of everything. It's not that. Okay. It is very specific. And my experience talking with people is they all have opinions. They all have things that they like or don't like, and yeah. So
okay.
Yeah. Level 4. I'm a professional level, otherwise known as the DIY level. What do you think that is?
Someone who manages their own investments.
Yeah, sure. The way he says it is they take a more active role in their investments. Yeah, which is exactly what you just said. They're willing to take calculated risks. I think we definitely have fallen into that category where they're like, yeah, there's some risk here, but it's okay. Like we bounded it. And he also says that their financial intelligence allows them to make decisions leading to substantial wealth accumulation. Yeah. And he also adds, like, usually they use their own money. He says...
So it doesn't really matter what type of investment you're making, whether it's real estate or stocks or...
Yeah, correct.
Somebody else's business.
Yep, 100%.
But you're more actively managing and deciding where you're going to put it.
Correct. Yes, 100%. Yeah. Yeah, that's the idea, is you're taking that active role. And there's all sorts. Yeah, real estate's definitely one of them. You could be a DIYer in directly investing in like stocks or commodities.
Is the assumption that businesses. as you become more active, I'm guessing the assumption that he's making in this, that as you're working up the levels, you're also learning how to do it. Because it's like, you could take a more active role and have no idea what you're doing and just be like, oh yeah, a frozen yogurt business, that sounds great. Or like, yeah, a movie theater, there's one for sale down the street, I'm gonna do that.
So you'll like this. I actually got this quote from it. He says, obviously, those who also invest in their ongoing financial education, taking classes regularly and hiring a coach to enhance their performance, will outpace those who just do it on their own. So yes, he agrees with you.
Right.
And I think that's
not just being more active. It's
I think that
evaluating the
if you are more active, it's understanding where you're at. And I do think people get themselves into trouble. That's why we picked up our 5-unit place. The guys jumped all in on that, and he was so overwhelmed he couldn't stand it. And so he sold it to me for what he bought it for, because he's like, I just can't anymore. And so that happens for sure. And but yeah, I think that's part of it. It's just being smart and having the education and the coaches
which is probably why you would like people to understand what they're investing in.
Yeah, I think so. And that's kind of that DIY part of it. Like when we do an investment, I put out that investment sheet and here's the offering, here's what it is. And like, you should read it. Yeah. You should try to understand it. Sure. Now, you don't have to spend hours doing it. You don't have to do all the education, but you should read and understand it. If you have questions, you should ask. And that's a worthy time investment. And that's why I kind of said it feels like a hybrid between the two. Yeah. Because it's not just set it, forget it. As a matter of fact, someone can't just give me their money and say, make magic happen, call me in 20 years, because then that turns me into something different that I'm not supposed to be. Yeah. They have to be the ones directly investing.
Okay. Yeah.
Yep. And it says here, the ease of raising capital is one of the biggest differences between being successful in the S quadrant versus being successful in the B quadrant, which is another way of saying the ease of raising capital is the biggest difference between the I'm a professional level and the capitalist level. Shocker, he makes an awesome name for
the highest
highest level, if you will. And again, there's pluses and minuses to everything. This level does not work for everybody. It shouldn't work for everybody. And the trick is finding out, okay, where am I comfortable with? Where do I want to land? And how do I optimize and make sure I'm being intentional about that? So, what do you think the capitalist level is? Which is like the one that's not like a self-describing name.
Well, the next level up, I would think, is someone who is taking some of those DIYer type of people's money and helping them to invest that in bigger deals or pooling it together, to be like, hey, yeah, you kind of understand this and you kind of understand this. So do you. Like, let's get together and do this bigger deal because you can leverage the amount that you have a little bit more.
Yeah. Okay. Cool. Yeah, one of the things he says is they not only seek to grow their own wealth and assets, but they contribute to the economy by creating jobs and opportunities for others, which I think is similar to what you were saying.
Sure.
He also does say like they have substantial wealth and use it to create more wealth to kind of keep that engine going. But yeah, the thing that I really view it as they contribute to the economy, they create jobs, and they create opportunities for others. And that's how I look at what we're doing, because we're bringing in other investors in our deals, creating opportunities for them, and doing the repairs and fixes, we're creating jobs, temporary ones, but jobs nonetheless. Sure. Like if the weather holds up, we're gonna get a roof replaced on our newest acquisition, which would be cool. That's creating a job, and that's awesome. True. And so, yeah, those are the 5 different levels.
Cool.
And I think it's just good to know where, what they are, what could be, what makes sense for you, what doesn't make sense for you, things like that.
I'm pretty sure had we never met, I would be a saver loser.
Oh, man. A loser saver?
A loser saver.
Man.
Oh.
Why do you think that?
Because that's definitely how I was as a child.
Yeah.
Actually, I was a spender saver.
Okay.
I don't know.
I don't know how those two things work.
So like my first job was a newspaper delivery person.
Yeah.
What do you call it? A newspaper carrier. Those don't exist anymore, I don't think.
I don't know.
Maybe. Anyways, delivered newspapers.
So it's hard to tell.
I got money from delivering, and I had to save some, put some to church, and then I got some to spend. And I would always like take a large portion of my spending and just go buy candy and come with it first thing, and then be like, well, if I have any left over, I'll put extra in savings. But then I would just squirrel it all away, and it was just like, I don't know, it's just going into savings for something.
Gotcha.
Whatever.
Interesting. Okay, all right. I was always a saver and then big spender. I was always saving my money for a big expense.
Still do that.
Exactly. We've talked about that, where there might be a month where like you might do 10 times as many transactions as I do, but I'll have one that outspends all of yours combined.
Yep.
That's how I roll. Yeah, cool. So there you go. Those are the 5 levels. Hopefully you found that interesting and kind of helps you think about what level you're at. And okay, I can do this without looking. And so, if you enjoyed this episode, we would absolutely love it if you would leave us a review and a rating wherever it is that you listen to podcasts, and have a fantastic day.